Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at the United States Oil Fund.
If you find our talks useful, please consider subscribe, like, and comment underneath because we are really looking at a market environment right now that fundamentally demands a complete shift in your wealth building playbook.
Yeah, absolutely it does.
Right, like if you just glance at the broader S&P 500 right now, you're seeing a really distinct wobble. We are navigating just immense uncertainty around the Federal Reserve and their next moves on interest rates.
Exactly. And those big tech earnings that, typically prop up the whole market, they're showing clear signs of exhaustion right now.
They really are. And when those traditional growth engines start to stall out, well, that capital has to go somewhere. The historical move is a rotation straight into hard assets. So we are currently experiencing the most severe oil supply shock in modern history.
Which is massive.
It is. And the objective today is to really understand how the United States Oil Fund operates as this highly liquid vehicle to capture this massive structural bull run, especially in a world where geopolitical risk has suddenly just, taken the wheel as the primary driver of inflation.
Right. But before we get into analyzing the price charts and all that, we really have to ground this in the physical reality that's dictating the market right now.
Absolutely. The actual barrels of oil.
Exactly. So the fund we're analyzing today tracks West Texas Intermediate Crude, which is commonly known as WTI, and it does this by holding near-month futures contracts. Spot prices are just, they're surging across the board.
Oh, totally. WTI has regained that really critical psychological level of $100 per barrel, right?
Yep, and Brent crude is currently trading in this really tight, elevated range. Between $99.50 and $111. The fundamental driver beneath all those numbers is just this massive, entirely unprecedented supply shock.
Okay, let's unpack this. Because the sheer volume of supply being removed from the market right now is staggering. We are dealing with an effective blockade of the Strait of Hormuz.
Which is tied directly to the escalating war involving Iran.
Right. And just looking at March alone, that situation has collapsed roughly 8 million barrels per day of OPEC supply. If you total it all up, an estimated 12 million barrels per day of regional production is currently completely shut in.
It's just a crazy number.
It is. To give you some scale, 12 million barrels is more than 10% of total global daily consumption just vanishing overnight. It's like if the world's most vital commercial highway is suddenly barricaded, and the cars stuck in that massive traffic jam aren't just carrying consumer goods, they're carrying the very fuel that powers the entire global economy.
That's a really great way to look at it.
Yeah, and if you are a nation or a corporation relying on that fuel, the price you're willing to pay for whatever remaining accessible oil is out there just skyrockets. But looking at the vehicle itself, if I'm an investor entering this really chaotic environment, how does an exchange-traded commodity pool actually secure its internal financial health when the underlying asset is just jumping around so violently?
What's fascinating here is the internal structural mechanism. Because, this fund does not own physical oil barrels sitting in some massive storage tank in Oklahoma.
Right. They aren't hoarding physical oil.
Exactly. It's a commodity pool that primarily holds cash, U.S. treasuries, and WTI crude oil futures contracts. The really vital protective detail here is that the fund is 100% collateralized.
Oh, wow. 100%.
Yes. In the complex world of futures trading, investors, they often use extreme leverage, meaning a sudden price drop can trigger a margin call, which basically forces them to liquidate their positions at a massive loss.
Which is the nightmare scenario.
Right. But because this fund holds cash and treasuries equal to the total value of its futures positions, there is zero risk of a margin call or a sudden liquidity crisis. It doesn't matter how wildly the market swings on a random Tuesday, they are protected.
That's a huge safety net.
It is. And beyond just downside protection, the fund's structure currently generates a massive internal tailwind through something called the roll yield.
Right, because futures contracts actually expire. The fund can't just buy one contract and hold it forever. It has to constantly sell the expiring one and buy the next month's contract to keep its exposure to the price of oil.
Yeah, in a normal calm market, that rolling process actually costs money. Calm markets usually operate in this state called contango.
Contango, right.
Meaning oil for delivery 6 months from now costs more than oil today because you have to factor in the cost of storing it and insuring it over that time. So in contango, when the fund rolls its position, it is constantly forced to sell a cheaper expiring contract and buy a more expensive future one.
So they're losing a little bit on every roll.
Exactly. That negative roll yield slowly chips away at the net asset value of the fund over time. But the current blockade has violently inverted that pricing curve into what we call steep backwardation.
Because the panic is so immediate. I mean, refineries and logistics companies, they need oil delivered tomorrow, not next year, and they're willing to pay a massive premium to get that immediate delivery.
Exactly. The front month contracts are trading at a massive premium to the deferred months right now. So when the fund manager sits down to roll the contracts today, they are selling the highly expensive expiring contract.
And buying the cheaper one.
Yes, they're buying the relatively cheaper contract for the following month, so they are effectively pocketing the difference. This structural tailwind systematically returns cash directly to the fund's net asset value.
Wow. So it acts as an internal financial engine that amplifies the outward price appreciation you're seeing on your trading screen. It's essentially being paid a premium simply to maintain its position during a crisis.
That's exactly what's happening.
But, the physical bottleneck at the Strait of Hormuz is really only part of the equation here. We have to look at the sentiment and those broader geopolitical shifts. The prevailing sentiment score for this asset is currently sitting at an 8 out of 10, which is overwhelmingly bullish.
Definitely.
But here's where it gets really interesting. We have this seemingly paradoxical catalyst hitting the wires. Right now, the United Arab Emirates is leaving OPEC.
Yeah, that was a huge headline.
Right. And if I look at basic supply and demand dynamics, the UAE leaving the cartel means they are no longer restricted by production quotas. They have the capacity to eventually pump an extra 5 to 6 million barrels per day entirely on their own. So shouldn't a massive flood of new unrestricted supply coming online theoretically be a deeply bearish signal for oil prices?
Well, I mean, in a 10-year vacuum, more supply absolutely exerts downward pressure on prices, but markets trade on immediate structural realities, right? Not theoretical vacuums. We have to examine what the UAE's exit actually destroys in the short term, which is OPEC's global market architecture. By losing the UAE, OPEC loses its primary shock absorber.
Because they don't have that spare capacity anymore.
Exactly. For a cartel to successfully manipulate global prices, it must maintain a massive buffer of spare capacity. Saudi Arabia and the UAE historically build expensive drilling infrastructure, tap the wells, and then literally cap them off. They pay maintenance costs on oil they aren't even selling.
Just to have that lever to pull.
Right. They hold that production back, so they have the power to instantly flood the market to punish competitors or drastically cut production to prop up prices.
It's their mechanism of control. Without that massive buffer of spare capacity, the cartel is literally just a group of countries pumping as much as they can with absolutely no ability to stabilize the market when things go wrong.
And the math breaks down entirely. With the UAE gone, analysts at Rystad note that OPEC's control of global supply drops instantly from 30% down to roughly 26%.
Wow, that's a huge hit to their leverage.
It is. Saudi Arabia is suddenly left completely alone to shoulder the financial burden of any future output cuts. Taking this vital stabilization tool out of OPEC's hands locks the global energy market into what analysts call a new regime cluster.
A new regime cluster. Which means what, exactly?
It signifies an era of extremely high structural volatility. And in commodity markets, high volatility mandates an elevated risk premium. Institutional investors basically demand a higher baseline price to justify the risk of trading in a fundamentally broken market structure.
Right. And the diplomatic rhetoric we are seeing right now is essentially cementing that risk premium into place. We are observing severe escalation from all involved parties.
Yeah, the headlines are pretty intense.
They are. Former President Trump has explicitly stated he will not lift the naval blockade without securing a comprehensive nuclear deal. Conversely, Iran's state-run Press TV is openly broadcasting warnings of unprecedented military action in response to any continued U.S. asset seizures. And just to be clear, we are looking at this impartially, without endorsing any political stance from either side.
Right, just reporting the facts of the situation.
Exactly. And these entrenched positions signal to the market that the 12 million barrel per day freeze is not going to be resolved over some quick weekend negotiation.
No. Not at all. The political posturing guarantees the persistence of this physical supply freeze, which fundamentally alters the macroeconomic environment. And this shift is exactly what dictates the flow of institutional capital.
Because the old models don't work anymore.
Exactly. The classic 60-40 portfolio relies on stocks providing growth and bonds acting as a safe haven during a downturn. But when a downturn is triggered by a massive inflation-driving supply shock, That traditional diversification fails completely.
Right, because energy-driven inflation crushes corporate margins, which sends stocks down, while simultaneously forcing interest rates up, which sends bond prices down.
Exactly. Both sides of the portfolio get hit.
So, if traditional asset allocations are failing, that capital is forced to find a new home. Looking at the sheer volume moving into energy hedges, it appears institutional allocators are actively abandoning the 60/40 model just to survive the inflation spike.
Yeah, the capital is flowing unilaterally into hard assets and energy right now. We're seeing major analysts, like Matt Orton at Raymond James, advising institutional clients to diversify entirely within equities by aggressively buying energy on the dips.
And the price action at the United States Oil Fund confirms this rotation, right?
Completely. We are observing a definitive technical breakout to multi-week highs. The heavy volume associated with this move indicates clear capitulation by short sellers.
So they're getting squeezed.
Big time. Those who bet against the price of oil are being forcefully squeezed out of their positions. They are mandated to buy back in to cover their losses, which just further accelerates the upward price momentum.
That makes sense. But the reason that institutional and retail capital is crowding into this specific fund, rather than simply taking stakes in major producers like Exxon or Chevron, comes down to the instrument's competitive moat.
Yeah, the structure matters a lot.
It really does. Because if an investor wants direct exposure to crude oil prices, the traditional route is opening a specialized futures account. And that requires dealing with strict margin requirements, managing complex monthly roll dates manually, and taking on the systemic risk of leveraged trading.
Which most people do not want to do.
Exactly. The United States Oil Fund acts as the de facto instrument to bypass all that friction. In the middle of an escalating crisis like a naval blockade, an investor needs deep, unrivaled liquidity. They need incredibly tight bid-ask spreads to enter and exit hedges instantaneously without losing capital to market makers.
Right. And looking ahead at the catalyst calendar for the next 3 months, there is a really consistent schedule of events poised to reinforce this technical breakout.
What should we be watching?
Well, every single week, the market processes the EIA crude inventory reports. These reports track the physical stockpiles of crude oil. And with 12 million barrels of daily production offline, these weekly reports are practically guaranteed to show massive, consistent draws from global reserves.
So every report showing shrinking stockpiles serves as a recurring bullish catalyst.
Exactly. Additionally, the next OPEC Plus meeting will be completely dominated by the fallout of the UAE's exit. The market will be watching closely, and any sign of further internal fracturing will push that risk premium even higher.
And tying this back to the broader macroeconomic picture, we have the Federal Reserve. They are widely anticipated to hold rates steady specifically because of this persistent energy-driven inflation.
Right. They can't pivot yet.
No, a central bank cannot declare victory on inflation when the foundational input cost for the entire global supply chain is just surging. So what does this all mean for you as you evaluate your portfolio today? When you observe a fundamentally altered macro environment, extreme momentum, and short sellers capitulating on heavy volume, the immediate psychological response is often fear of missing out.
Sure. FOMO is real.
It is. So is the momentum so extreme that this trade is already too crowded for a new allocator to enter safely?
Well, if we connect this to the bigger picture, the data suggests the trade is actually not overly crowded because the structural deficit is already permanently baked into the back-end futures curve.
Meaning what, exactly?
Meaning the market isn't just reacting to today's spot price, it is looking at the price of oil contracted for delivery 6, 9, and 12 months from now.
Yeah.
And those forward-looking prices are being heavily revised upward across the board.
So they see this lasting a while.
Exactly. This indicates that institutional capital does not view the blockade as some fleeting temporary spike. They are pricing in a protracted, long-term shift in the global supply-demand balance.
Right.
And because that structural deficit is recognized as persistent, this fund transitions from being a speculative, short-term trade into a mandatory, ongoing inflation hedge. Major allocators are essentially required to hold it to protect the purchasing power of the rest of their portfolio.
It's an anchor against a sustained macroeconomic headwind, not just a momentum play.
Exactly.
However, rigorous risk assessment is the foundation of any wealth-building strategy. We really must examine the bear case. What specific scenarios could fundamentally break this bullish thesis, and how resilient is the asset against those risks?
That's the whole question.
The most prominent risk, I think, is a sudden, unexpected diplomatic de-escalation. What happens to this trade if a surprise peace treaty is signed tomorrow morning, The Strait of Hormuz is officially reopened, and those 12 million barrels per day are technically free to return to the market.
That is undeniably the primary risk to the thesis. But the mitigating factors are uniquely robust here. On the diplomatic front, the high barrier conditions set by President Trump, specifically requiring a comprehensive nuclear deal before even lifting the blockade, make an overnight resolution highly improbable.
Right, multilateral nuclear treaties historically require years of complex negotiation.
Exactly. But the ultimate mitigation factor isn't actually political. It is the physical, logistical reality on the water.
The actual mechanics of reversing a naval blockade?
Precisely. It's how a blockade is physically enforced and dismantled. Because even as a binding peace treaty were signed today, commercial oil tankers cannot simply resume sailing through a heavily mined international waterway.
Oh, wow. Yeah, the
Right.
mines.
Clearing a complex network of naval mines is a painstakingly slow, grid-by-grid process. It requires deploying specialized fleets of mine sweepers, utilizing acoustic and magnetic sweeping technologies, and sending autonomous underwater vehicles just to physically verify the safety of the shipping lanes.
That sounds incredibly slow.
It is. Military and logistics analysts estimate that physically clearing the Strait of Hormuz to a standard deemed safe for commercial supertankers will take an absolute minimum of 6 months.
Wait, really? Six
At
months?
least.
I think it is very easy to view geopolitical events purely through the lens of a news ticker.
Yeah.
A headline drops, and the market assumes the underlying reality shifts instantaneously. But the physical constraints here are just staggering.
They really are.
Even if the political conflict is entirely resolved tomorrow, the logistical chokehold on the global oil supply remains securely tightened for half a year. The ships physically cannot move. That reality seems to establish an incredibly secure time frame for the trade.
It absolutely creates a hard physical buffer against a catastrophic price collapse triggered by a sudden diplomatic headline. Now, the second major risk involves the UAE, tying back to their exit from OPEC.
Right.
Because once the strait is eventually cleared and fully open for commercial traffic, the UAE will look to monetize their reserves immediately since they are no longer constrained by cartel quotas. They will want to pump at maximum capacity.
Which brings us back to the threat of the market being aggressively flooded with new supply.
Exactly. But the mitigation for that risk is deeply embedded in the last decade of the energy industry's financial history. Yes, the UAE has stated they intend to act responsibly and bring new capacity online gradually. But the real structural defense against a price crash is the decade-long drought in global upstream capital expenditures.
So a lack of investment in drilling.
Precisely. For the past 10 years, due to various economic crashes and a major pivot toward different investment mandates, the global energy sector has severely underinvested in exploring for new oil and building new drilling infrastructure.
You can't just flip a switch and have a new rig.
No, you cannot build a deep-water rig overnight. It requires years of advanced funding. Because that funding hasn't existed, global supply is highly constrained right now. Global demand is robust enough to easily absorb the UAE's incremental supply increases over time. That decade of systemic underinvestment establishes a very firm floor for oil prices, heavily limiting the downside risk even when unrestricted pumping eventually begins.
So, to synthesize this, we are looking at a massive, immediate 12 million barrel per day supply shock. The fund utilizes an internal collateralized structure that captures the contango to backwardation shift, which effectively generates a yield just for holding the position.
Yep.
And critically, the most bearish scenarios, diplomatic resolution and unrestricted pumping, are physically delayed by a 6-month naval mine clearing operation and buffered by a decade of underinvestment.
This raises an important question regarding the specific investment horizon for this strategy. Based on the physical and financial dynamics we just outlined, this is not designed as an intraday trade, nor is it a forever hold asset for a 30-year retirement account.
Right, you're not passing this down to your kids.
Exactly. It is a clearly defined 3 to 6 month position trade. The objective is to hold the asset through the period of maximum geopolitical friction and maximum supply constraint.
Okay, so when does an allocator look to exit?
An allocator should only look to heavily reduce or exit the position when 2 strict conditions are met. A credible, binding ceasefire is officially established, and D, the physical, logistical clearing of the naval mines in the strait has observably commenced. Until both of those physical conditions are met, the supply constraint remains absolute.
That structural alignment is incredibly rare. You have an 8 out of 10 bullish setup driven by an unparalleled physical supply deficit. You have a financial instrument actively benefiting from positive roll yield dynamics. And you have institutional capital systematically flowing away from broken 60/40 portfolios directly into these energy
It's
assets.
a perfect storm.
It really is. For an investor looking to capture this specific geopolitical reality without the friction of a futures account, the United States Oil Fund serves as the premier, highly liquid vehicle to execute this 3 to 6 month thesis.
The convergence of an intractable geopolitical conflict, physical logistical barriers, and a fundamentally altered technical market structure forces a complete recalibration of how risk and inflation are managed within a portfolio today.
Absolutely. And before we wrap up, let's just look past that immediate 6 month horizon for a second. We are deeply focused on monetizing this specific supply shock today. But if OPEC continues to fracture and permanently loses its ability to function as a global shock absorber, and if the Middle East solidifies into a permanently high-risk premium zone where crucial supply routes can be completely paralyzed for half a year.
Yeah, what happens then?
Exactly. How does this structural shift affect the broader global economy? Will this intense, sustained financial pain from fossil fuel costs act as the ultimate catalyst to accelerate the global transition toward domestic, decentralized, renewable energy? Are we analyzing a highly profitable 3 month oil trade, or are we actually watching the chaotic opening stages of a permanent, irreversible energy paradigm shift?
That is a fascinating question to consider.
And that is the systemic secondary effect we have to monitor as this all unfolds. A short-term structural trade can often be the leading indicator of a multi-decade macroeconomic transition. It is precisely why examining these underlying mechanics is so vital to protecting and growing your capital. Thank you for joining today's analysis. Stay informed, look critically past the headlines, and continually track where the institutional capital is truly flowing. We will see you next time.